So if we value for the direct write-off method, the direct write-off method, we just know that we can't collect a certain amount. So this is when we know, when we hear from a company that, hey, we're going bankrupt, we can't pay you, or we've heard from their from other vendors that they haven't been paid, or we know that, or they've reached out and said, we don't like your product, we're not going to pay you. We know exactly what we can collect, and we're going to debit bad debt expense and reduce our accounts receivable. Notice that we have to note the specific customer, because in the subledger or in our accounts receivable reconciliation, or also known as account receivable aging report, we didn't know what customers owe us and what don't, so our debt collection team can follow up with them. Kent was able to make full payments, and so if they were able to make the full payments, then we'll just reverse the entry. And so that happens sometimes, where in January we determine a company won't be able to pay, but then the company decides, either does better after the bankruptcy, or decides that they need the product. So a good example is if, let's say as a consultant, someone decides they don't want to pay me, so I tell them, okay, well, I can't do any services for you because you're not paying me. But then next month they determine that they do need me, they might pay me instead. So then I would reverse the bad debt expense, so we'd have the accounts receivable back, not have the bad debt expense on our books anymore, and then just collect the cash. These journal entries are going to be key. I expect you to be tested on them. So make sure any of these journal entries you understand, or ask me questions about when we get off sharing the slides. Matching versus materiality. Okay, expense recognition. So I think remember back to the original 4 chapters that we have the matching principle, right? Matching principle is we recognize revenue when it's earned as a revenue recognition principle. And then the matching principle is we have to match expenses to the revenue that we create. And so theoretically, we should be increasing our bad debt expense and our allowance as we recognize revenue, which becomes difficult because then we have to estimate the bad debt expense. The way we would do this generally is by a simple calculation of determining how much bad debt expense we've received by customers over the last year or over the last 3 months. And then let's say it's 1% of our sales, and then taking that percentage going forward. Some companies get much more complex and break it off by customer class, or different large customers versus small customers or regions. But the general theory is we're just estimating based on what's happened in the past. There's new accounting laws or guidance coming out that's going to make it so you also have to consider future economic impacts as well in your valuation, but we will be covering that in this class. That's going to be called CECL, though, if anyone's interested in looking into it. CECL, credit reserve losses. Materiality constraint. Normally we'll ignore amount if it's unimportant to the business user's decisions. So materiality is just an important part to get, an important definition to understand as a class for the rest of your accounting education and business education. And so I relate this to when I was in college and I was very, very broke. I remember if I had $100 in my bank account, I would be pretty happy. And so if I bought a sandwich, that sandwich was a material purchase to me. If that was a $5 sandwich, that was a pretty big purchase for me because it's 5% of all of my money, right? 5% of all of my assets are going into that sandwich. So that's a material purchase for me. But 10 years later, 5 years later, 10 years later, if someone has $100,000 in the bank, that $5 purchase for that sandwich is not going to be material anymore. Same thing, companies think of business the same way. And so if I have a small company that makes $100,000 a year, the materiality threshold for that company is going to be very low. And normally you say it's about 5% of their income or 5% of their assets. And so any purchase under 5% or under, it might be seen as immaterial, and some companies will even have a lower threshold, like 1%. Which means that if a transaction occurs below that, we really don't care about it as long as it doesn't affect the financial statements by 5% or more in aggregate. And so same thing with a bad debt expense. If it's immaterial, if we know our customers are 0.1%, 0.2% bad debt expense, we really aren't going to care about it. And so we might ignore it for financial statements because it's unimportant to users' business decisions. But if it's greater than that 1% to 5% ratio, then we can't use a direct write-off method. So Again, we can only use the direct write-off method if it's immaterial. Immaterial being, the true definition of it is an amount that can be ignored if its effects on the financial statement, because its effects on the financial statement is unimportant. If it is material, so we're saying greater than that 1%, where it would influence someone who is interested in purchasing the business, then we need to disclose it and do the allowance for doubtful accounts method, or the matching method over here. So allowance method versus the direct write-off method. This is only if it's immaterial. This is if it's material. Again, make sure you know this for your exams, and just going forward, if you don't see a company has write-offs on their books, if you're ever looking at financial statements as you progress in your finance education, the reason might be because that allowance for doubtful accounts is immaterial, while if we see the allowance method disclosed, it's probably material. Okay, so we're going to go over this method next.